So Caleb, make sure that your mic is muted. So it's a great time for the one who is asking that which topic are we doing? We are doing insurance. So how an insurance firm prepare their books of accounts. Last time we did banking. So today we are doing insurance. So that is the topic of the day. So we are going to do a question from financial reporting, December 2014, question 4, because so far we don't have any question in the advanced financial reporting. So I can go ahead and read the question. So the first part, already you have it in your notes. The difference between commission on reinsurance ceded and commission on reinsurance accepted. Then they said the foreign trial balance was extracted from the books of Apex Insurance Limited, which specializes in general insurance. So we have direct premium received, reinsurance premiums received, reinsurance premiums paid, accounts receivable, bank balance, and cash in hand. Then we have the aspect of unearned premiums. Unearned premiums as at 1st November, claims outstanding as at 1st November, claims paid, legal costs, survey expenses relating to claims, bad debt written off, investment in shares, freehold property, we have a motor vehicle, machinery and equipment, furniture, audit fees, directors' fees, depreciation on non-current assets, management expenses. We have accounts payable, investment income, ordinary share capital, share premium, retained profit as at 1st November 2013, premiums outstanding as at 1st November 2013. So additional information. Number one, premiums outstanding as at 31st October 2014 amounted to 36,000, and that is 36 million and 16,800,000 for marine and fire. Claims intimated and outstanding as at 31st October 2014 amounted to 18 million for marine insurance and 11,520,000 for fire. Number three, unearned premiums reserves for unexpired risk is to be maintained at 100% and 50% of the premiums for marine and fire insurance respectively. Number four, commission on both reinsurance ceded and reinsurance accepted is at the rate of 5% of the premiums. The directors have proposed a dividend of 5% on outstanding share capital as at 31st October 2014. The tax rate is 30%. So we are asked to do a revenue account, statement of comprehensive income, statement of financial position. So when you are starting with a revenue account, remember you look at that farm, what was it dealing with? So looking at this question, you can see like now under direct premiums received is for marine and fire. Reinsurance premium received is for marine and fire. So their policies were based on marine and fire. So when doing the work of revenue accounts, we'll be concentrating on the marine and fire. We'll be concentrating on the marine and fire. So the company is called Apex Insurance. I think you have the question, because now I'm stopping the sharing. You have the question. So it's a question of December 2014 from FR. Question 4. So it's Apex. So Apex Insurance Limited. Apex Insurance Limited. So on this scenario, we are going to do a revenue account. Revenue account. So for our financial year ends for the year Our financial year ends on our financial year was ending on 31st October 2014. 31st October 2014. So it's shillings in thousands, and we have shillings in thousands. So we'll have two columns because we are dealing with marine, and we will be dealing with marine and fire. No, so Rogers, it's not for 2070. That document has many questions. So it's upon you to open that document and go to this sitting. So Rogers, have you opened that document? That document has many questions. It's only that it starts 2017. So open that document, go to this year. So I will be dealing with marine and fire. So we'll be dealing with marine and fire. So marine and fire. So I said we start with premiums. We start with premiums. So starting with premiums, we start with direct premium received. Are you seeing that direct premium received? So these are direct premium received from the relevant parties, which you are insuring against marine and fire in this company. So they are insured parties against marine and fire in this insurance firm. So we start from direct premium received, and then we will be talking about the reinsurance premiums received from another insurance firm. The insurance premium received. Reinsurance premium received. Then if you paid to another firm, reinsurance premiums paid. Reinsurance premiums paid. After insurance premiums paid, we talk about outstanding what? Outstanding premiums, balance brought down. Then outstanding premiums, balance carried down. Outstanding premiums, balance carried down. So you can see the direct premiums received. The direct premium received. So which are the direct premium received according to the question? You can see there 108,000, and I can see in my question here 84,000. Then we have reinsurance premium received from another insurance fund. Again, that one is given in the question direct. So that is 28,800 and what? And we have 19,200. Then we have reinsurance premiums paid, the one which were paid to another insurance firm. The one which were paid to another insurance firm. So reinsurance premiums paid, you can see there's 19,200. So now this one we minus because we are paying to another insurance firm. 19,200 and 12,000. This one we deduct because we are paying to another insurance firm. Another insurance firm. Then outstanding premiums balance brought down as at the year when it was starting. Remember our financial year now starts on 1st November 2013. So according to the question there, I can see down there, we have 21,000. I think you are seeing these figures. I have the hard copy here. That is where I'm picking my figures from. Also, you have yours. So like now the outstanding premiums is down here. The outstanding premiums. Premium outstanding, this one is 1st November. The 21,600, 21,600, and this is 16,800. So the one which is outstanding as at the start of the year. So that is from the previous year. So remember that one now we deduct because there's some premiums which we paid this year. Not we paid, we received, yes. we received. So there's a sum we never received by the end of the previous year. But now those parties have given us premiums this year. So we minus what they never paid in the previous year. We deduct. Then now we add the outstanding premiums balance carried down, which is under the additional information. Looking at the additional information, you can be able to see there's premium outstanding as of 31st October 2014, 36,000 and what? And 16,800. 36,000 and 16,800. 16,800. So up to this point, we have done something. And up to that point, we have a net premium. So give me the figures for net premium. So do the summations. So after that, remember that we are going to look at unearned premiums balance carried down, unearned premiums balance, unearned premiums brought down, balance brought down, and we have unearned premiums. Unearned premiums. So the unearned premiums balance carried down. Unearned premiums balance carried down. So give me this total first and this one. Someone?
The first one I'm getting 132,000.
And the second one?
91,200.
91,200. And then we look at unearned premiums balance brought down. The premiums which are set aside together for the one you doubt might not be received. So what you set aside as at the start of the year, 1st November 2013. So the unearned premiums brought down. Let's look at, so you can see here, there's this unearned premiums, 1st November 2013, 115,260,000. Then now the unearned premiums balance carried down. I think it's under the additional information. No? Additional information number 3. Unearned premium reserves for an expired risk is maintained at 100% and 50% of the premiums. Or 50%, 150% of the premiums. So first we write this one. This one is 100 and what? 115,200. And this one is 60,000. Then now we are told the other one is maintained at 100% and 50% of the premiums. Premiums is this one, the net premiums. The net premiums. So meaning that this one at 100%, it will mean to be 132. 50% of 19,200, 91,200, 40 something, 40?
45,600.
45,600. Remember now the balance carried down, you deduct. So that up to that point, you get your gross revenue. You get your gross revenue. And this one is closed at this point. We call it A. We call it A. So this one will be this plus this minus this, it will remain to be 115, 200. What about this? 91,200 plus 60 minus 45,600.
$105,600.
This is 105,600. All right. 105,600. So we have marine and we have fire. So remember that the second part, after premiums, we said we go to claims. We go to claims. So you start with claims paid. So the claims which you paid. Claims paid. Sorry? Any question?
Mwalimu, just kidogo your camera tuoni za chini, like the last line. Kama ni kwangu peke yangu.
You need to think maximize your screen. Maana kila mtu ana experience hiyo.
That's okay.
That is okay.
Yes, yes.
So creams paid, creams paid, creams paid. So this is 59 to 80. According from the question, eh? And this one is for fire. 43 200. Then after creams paid, I said we go to the one which are outstanding, creams outstanding as at the start of the year. Then we look at the end of the year. So creams outstanding, creams outstanding, balance brought down. Then creams outstanding as at the end of the year. Balance carried down. So the one as at the start of the year, according to the question, brought down. Which figure do you have? So from the question, so the claims which were outstanding as at the start of the year,
19,200.
19,200, 19,200, and we have 19, that is 12,960 for marine and fire respectively. Then for the balances carried down, they said something in the additional information. Remember that the claims outstanding is the claims which have not yet been paid. Another name for outstanding, we said is intimated, the one which have been approved but not yet paid. So if you look at additional information number 2, they call it claims intimated and outstanding. You are given 18,000 and 11,520. So here we have 19,200. So remember that these are the one outstanding from the previous year. So we minus, since there is some which have been paid this year. Then this one was 12,960. Then we add the one which is carried down. As the additional information, you are given 18,000 and you are provided with 11,520. So you give me the totals here. And this one, we call it B. Then after claims, we talk about what? Commission. Eh? So we have 2 commissions, accepted and ceded. Eh? Commission, that is commission accepted and ceded. Commission accepted and commission ceded. So when we look at this, you need to understand the... Yes.
There was a specific expense for the survey marine expenses.
See, we are going to expenses. We are not yet going. We are not yet done.
Is it not being recorded claims?
Did they say rating? Which one? Which one are you talking about? Legal, bad debts. Which expenses are you talking about? Did they say that it's related to claims? So we have claims paid, legal costs. See, expenses I can see, the one which will appear in the revenue account is legal costs. Or survey expenses relating to claims. Eh?
That one.
Yes, that one is supposed to appear. Sikuwa nimeona hii. So we include, it's okay. They were very specific. Because they were very specific, they said survey expenses relating to claims. Survey expenses relating to claims. So survey expenses include here. So it's for marine, marine only. That is it was 70 something.
7680.
7680. So include it there, then you will get the total, and that one will be B. All right. Then I was explaining about commissions, accepted and ceded. So for commissions, you have to understand about these, reinsurance premiums, received and paid. So reinsurance premiums, reinsurance premium, we have reinsurance premium received, and the one which is paid. So our commission will be based on that. So which commission is receivable? So we say that commission accepted, the one which is accepted is the one which is payable. Accepted is payable. So meaning that if the commission accepted is the one which is payable, it's based on this, the premiums which you received. So accepted will be under this. So because reinsurance premium received. So if you received some premiums from another insurance, remember that you give them a commission. You give them a commission. So that commission is commission accepted. The one which is payable. Then ceded is receivable. When can you receive what? When can you receive commission? When you give out premiums. So ceded will be under this. So that is why they give you a percentage. A percentage, but now that percentage you will apply on these values. So that percentage, that is what they said in the additional information that if you look at your additional information, they said there's a commission, that is additional information number 4. Commission on both reinsurance ceded and accepted is at the rate of 5% of the premiums. But now which premiums? As explained. So meaning that when I will be doing accepted, I will use my insurance premiums received. So 5% of this, 5% of 28,800, and 5% of this. 5% of 28,800, what do you have?
1440.
1440.
1440. Then 5% of 19,200.
960.
960. So meaning the same year we have 960. Then 5% of 12,000.
600.
600. So you can decide to net either. So I will net ceded from accepted. So that this one will be our C. Then now we go to expenses. We go to expenses. Now the expenses I will be dealing with here are a specifics. The one related to marine and fire. The one related to marine and fire. So looking at the question, we have expenses like legal, because now they are very specific. So legal, we have legal costs. So legal cost to marine, it was 4320. You can see from the extract given there. And this one is 3120. Another expense which is specific to marine and fire is bad debts written off. Bad debts written off. Bad debts written off. So bad debt written off 4080 and what? 2880. Then now we have management expenses. Management expenses. So management expenses. So for the management expenses is 15,600 and what? 13,920. So this one will be D. So have you been doing the total? This one?
480.
Where is 480? And this one? Three what?
360.
360. This one? So get those ones. Then now finally we will have an underwritten profit or loss. So it can be a profit stroke loss. And now use your A, you minus B, C, and D. Do that one and give me the answers. Yes. Do you have the answers?
Yes.
So this one is
24,960.
Sorry?
24,960.
And this one is
43,560.
43,
560.
560. So then the net, the underwritten profit or loss, or that is the one you are saying? Underwritten profit or loss, do it.
That's the underwritten profit or loss.
Oh, so this is
The
24.
total expenses is 24,000.
So total expenses is 24,000. And here we have
1920.
1920.
9920.
19,920. And so this one was 43,
43,560.
560.
560.
And so we are done with the revenue account. So we do statement of profit or loss, the statement of comprehensive income. So let me clear this sign and we do that. So if they test that question, it will be a 20 marks question, you know that. So it will be a 20 marks question. Anyway, score less than 20. It's like now banking. If they test banking, 20. And some of you did this in FR, maybe the one who did sometimes back, and now you are coming back to finish. So we do the statement. So Apex remittent. So statement of comprehensive income. So we talk about statement of comprehensive income. And the thing about having a class on Wednesday, during the day, you can do it in the morning because it will be an holiday to recover as to this class. So our financial ends on that 1st October 2014. So statement of comprehensive income. Statement of comprehensive income. Now you start with this, underwritten profit or loss. So the profit we have there. So that is the one we start with. So it's an income. Remember that under income statement, we talk about incomes and expenses. We talk about incomes and expenses. So shillings in thousands. Then here we have shillings in thousands. So income, we have underwritten profit. Underwritten profit. So for this underwritten profit is for marine, and we have for fire. We have for marine and fire. So what you do, you have to sum them. So we have 24. So I can record anyway on the credit side direct, 24, 960, and what? 43, 560. Then is there another income which can be added here? Add other incomes. Now the general. So any income?
Investment income.
Investment income. That is good. So if you look at your question, you will be able to see somewhere investment income. Where is that? Where is that? Where is that? Yes, investment income. So it's after the accounts payable. You can see on the credit side, we have 7920 investment income there. After the accounts payable, there's an investment income.
It's not 6720.
Nimepick vibaya. So I have picked the wrong one. Yes, it's it's 6720. 6720 after the accounts payable. Accounts payable is the one which is 7920. So up to that point, we have a gross revenue. Then after gross revenue, so we minus expenses, less expenses. Now the one which are the general for the business, the one which are not related to marine, and remember, like now these ones were very specific. That is why they appeared here. Now the expenses which would appear here are the one which are the general in nature. So expenses of which kind? If you look at this extract, you have audit fees, directors' fees, depreciation on non-current assets. Audit fees, directors' fees, and the depreciation. Those are the general. So those are the ones to record. Audit fees, you can record that under expenses. Directors' fees, and we have depreciation. We have the depreciation on non-current assets. On non-current assets. So audit fees, 5760. 5760 there, 11,880. And we have 21,720. So those are the one I've recorded there. So you sum, you deduct from your gross revenue. So the total of the three, what are you getting there?
39,360.
39. So that is 39.
39,360.
360.
Yes.
So sum your gross revenue was. So if I take 24,960 plus 43,560 plus 67,20, 75,240 minus 39,360. We have 35.
$35,880.
35,880. So 35,880. So after 35,880, so that is a profit before tax. So in the question, we are told that the tax is at what rate? Equation yangu imepotea kabisa. We were told that the tax is at which rate? 30%. Obviously, you know that. But were we told that? Yes, in the additional information number 6, tax rate applicable is 30%. So income tax. So 30% of 35,880. 30% of 35,880. Give me the answer.
10,764.
And 10,764 deduct. Get a profit after tax.
Twenty-five 116.
20?
25,116.
All right. So after that, remember they talked about dividends. There is a proposed dividends. If you can look at additional information number 5, the directors have proposed a dividend of 5% on outstanding share capital. So the outstanding share capital is 5%, so that we pay out of, we deduct out of the profit we have. So the share capital here, ordinary share capital is 72,000. So 5% of 72,000. So you deduct, I think you are seeing down here. There's proposed dividends. 5% of 72,000. 0.05.
3,600.
3,600.
No.
And then deduct that from 25. So what are we getting after deducting that? 36. So that we have profit for the year. After that,
21,516.
25.
21,516.
560. Then now we add the retained profit brought forward from the previous year. Retained profit balance brought down. Then we have now the retained profit, which we are supposed to carry forward to the next financial year, which is a retained profit balance carried down. So if I look at my equation, the retained profit brought down is 10,800. 10,800. So that you add to 21,516. You get your retained profit balance carried down. What are you getting? So that next we do Apex remittance, Apex insurance remittance. Statement of financial position. 30.
32,316.
So under assets, we have main assets to record here. You can see from the question, the assets which are present. So here we have these assets: investment in shares, freehold property, motor vehicle, net book value, machinery and equipment, net book value, furniture. So those are the ones to record. Investment in shares. So non-current assets. So non-current assets, and we have investment in shares. So investment in shares is 33,600. Then we have freehold property. So freehold properties, 100, 800. Then we have motor vehicle. So motor vehicle is 84,000. We have machinery and equipment. So the machinery and equipment is 36,000. Then we have furniture. So furniture is 31,000. So current assets. Remember, obvious, the statement of financial position is very simple. So current assets, charging with receivables, the debtors.
Mwalimu, I have a question.
Mm-hmm.
Are we not supposed to less the depreciation on the total assets, total non-current assets, sorry?
No, remember that already they have said net book value. What's net book value? They have already deducted that. So you
Sorry, I
see,
hadn't seen that.
sorry?
I thought they were at cost, not net book value.
Net book value. Already that one has been catered for. So account receivable. We have a bank balance. This is 31,200. Funny, yeah? Yes, so accounts receivable, it's okay. So bank balance and cash in hand. Bank balance and cash in hand. This one is 2640. Then now, remember that the premiums which are outstanding premiums, the one which have not yet been paid, outstanding premiums, but now carry down. Those are your assets because they will be paid. You need to receive premiums from the insured parties. So the carry down is a current asset. Outstanding premiums carry down. So you sum the two for marine and fire. So for marine and fire, you sum them. So you get what? Which figure are you summing up? The one in the additional information. So in additional information number 1, premiums outstanding, 31st October 2014. So 36,000 and the 16. So 36,000 plus 16,800 plus 16,800. What are you getting on that? Doing that? So that is
52,800.
52,800. Then another set is all about commission ceded. The one which is receivable. This is a receivable. Based on reinsurance premium done what? Reinsurance premiums paid. So again, you sum. Tulikuwa tumepata ngapi na ngapi? For fire it was the seeded for fire.
1440.
Sorry?
1440.
1440 plus
960.
960. You get a total of
2,400.
2,400. Commission seeded is in seeded amount accepted.
It's 960 and 600.
960 and the 600. So this is the one which was seeded. So you get a total of
1560.
1560. All right, so we go to other parts of the statement of financial position. So the next part is all about equity. Equity and liabilities. So the capital, we have the ordinary share capital for equity. So ordinary share capital was 72,000. Once you unmute me, if you are not answering any questions so far, you remain muted. So 72,000 ordinary share capital. We have share premium. Share premium is 24,000. This one is just direct from the question. We have retained profit. Now remember that the retained profit I'm picking is the one which is here, the bottom line here. The 32,316. The 32,316. After that, retained profit, we talk about the reserve, the Anand premiums, Anand premium reserve. The one which is set aside to cater for the premiums which might not be received, but now carry down. So the Anand premiums reserve carry down. It was at 100% and 50% of the premiums. I remember that. So it was 132 plus, it was 40 what?
45,600.
600.
And so if you sum those two, you get what? What are we getting?
177,600.
177,600. Aye. Then now, was there non-current liability?
Accounts payable.
Hakuna.
No. So non-current. So we go to current. So accounts payable. It was 70 something. So accounts payables is 7920. Then from the question, there's this outstanding claims, the one which have not yet been paid. So claims, remember that you pay. So the one which have not been paid by the end of the year, carry down. Outstanding claims carry down. Eh? So the outstanding claims carry down as at the end of the year. So the one which is additional information number 2, claims intimated and outstanding amounted to 18,000. And we have 11,520. 18,000, 11,520. And 11,520. So the sum of the two?
29,520.
29,520. Then we have there is commission accepted, which is supposed to be payable. Commission accepted. So the one which you are giving us 1440 plus 9 what?
60.
960. This one was giving me a total
2,400.
2,400. So this one is payable. It is based on it's based on reinsurance premiums received. Then after this one, we might check there was proposed dividends, the one which you were supposed to pay based on the 5% of the capital, 5% of the capital. So we got which figure?
That's 600.
3,600. Again, looking at the question, is there anything remaining?
Yes.
Which one?
Current tax. Yes.
Income tax. So income tax was, the 30% was?
10,764.
10,764. So yeah, we have total equity and liabilities. So you can check if it's balancing, and that will be the end of this topic. There's nothing else you need to know. It's just understanding how you do revenue accounts. You understand how you do income statement and the statement of financial position. So this one you are getting the assets. According to my calculator, assets
6120.
Equities and liability, are you getting the same?
Ndio.
Yes.
Yes, 360, 120. That is it. So I think for the small topics, the one which are remaining, according to what we have done so far, topic kidogo sense imebaki ni impairment of assets. Ndio. An impairment of assets, leases, and which one? These two, eh? There's that, so there's that content we wrote when we started. Anybody who was here from the word go? The small topics. Hmm?
I think it was segmental reporting.
Segmental, we did the first one. Cindy, the rights of Chancellor.
Yes.
We did this. You were here from the start, eh? Yeah. So what's remaining, I think, for the small topics are these. Are related parties, those are theory. Now, I don't want to do these ones first. I want to move to major topics. The one which will assist you in your exam. So we have reconstruction. That is the one I will be talking about. Reconstruction and reorganization of capital structure. Now, if you have a colleague who wanted to join this session, this is the time sure you must consider to join. Eh? Because now we are moving to the main area now, reconstruction and reorganization of capital structure. So that is what I will be talking about. Then there's EPS, there's group, and there's published. So that is what we will concentrate with this month and next month. Kazi, Azumaisha by next month. So let's start from reconstruction. Out of these, 1, 2, 3, 4. 3 are always in your exam. 60%. So when we talk about reconstruction, what do I mean? This one was there in your sitting. So reconstruction, and there's someone who's making noise. So reconstruction, you will find that a company is on financial distress. A company is not on a position of making profits. The company is in a position of generating losses. So if this entity is generating losses, we can opt for a reconstruction. As the people who have an interest in the company, we can opt for reconstruction. So you know that the company is making losses. So what can we do to turn around the entity? So we can decide to do an internal reconstruction whereby we'll be able to alter the capital structure of the entity internally. Because the obvious, what builds a company is all about the equity. We have ordinary shareholders, preference shareholders. Yes, those are the people in the company, and the loan providers, the debentures. So these are the people of interest in the company who will say that if the company is making losses, we can do internal reconstruction, whereby we'll be able to appoint an individual called a receiver to assist us in doing this. So which are some of the things which can be done when we do internal reconstruction? So before I go to that, remember that under internal reconstruction, if the company was called Edwin Limited, it will remain to be Edwin Limited. the company will be able to maintain its legal identity. But what we alter is the structure of the entity, not anything else. Like now, what can you change? If you want to turn around the company, you look at your shares. We can be selling shares at a higher price. And this one is not motivating more shareholders to come in. So we can opt to reduce the price of a share. If it was 10 to 5. Then another thing which can be done internally is how our loan providers are supposed to be paid. So if you have a short-term loans you need to pay, you can make arrangements to prolong them. So we can be able to do what? To say that instead of paying for a short period of time, let's change them to be long-term loans so that we have a good plan of paying. That is what even generally the country does. Like now there was loans which they were supposed to pay. So they were consolidated and time is prolonged of paying. So that is another proposal which can be done. These people called preference shareholders who are supposed to be paid dividends always in a financial year when we make profit. So if we never made profit, because that we have not made profit, yes, we can have another plan of even giving them shares now. They can be given ordinary shares. Even the loan providers, instead of paying them, you can tell them, come into the company, you are given shares, part of the shares of the company, so that they offset the loans. So it's all internal reconstruction is all about things which can be done internally to change the company from that position of making losses so that it starts generating profit. So under reconstruction and reorganization of capital structure, we have internal reconstruction and we have an external. Now, when I will be going to external, here you will find that there is a new entity which is formed to take over the operations of the old company. You know that under internal, it was just altering the capital structure without the company losing its legal identity. But now under external, if it was Edwin Limited, a new company, let's say called Ochoi Limited, is formed to take over the operations of Edwin. So these people in Edwin Limited must be paid. The providers of capital in this company must be paid. They must be compensated. And this work of reconstruction under external is done by a liquidator. It's done by a liquidator. So under external, a new company is formed to take over the operations of the old company. So here on this scenario, the providers of capital in the old company must be compensated. So there's a process which is followed when we do external reconstruction, starting from the point of determining the purchase consideration. So the company is like, it's sold. So it was sold at what amount? And this is whereby we will be able to show how the providers of capital in the old company are compensated. So that is the first step of determining purchase consideration. You have these notes. So it's just reasoning and you understand and we do questions. So when we talk about external reconstruction, first step, determine purchase consideration. Amount payable by the old, that is old company. That is amount payable, sorry, by the new company to the old company, because now the new company which is formed is the one which is taking the operations of the old. So new company compensates old. So you will be given additional information how that compensation is done. So that is the first step. Step number 2, there's books of accounts to be closed in the old company. So we have to close the books because now the company is now becoming non-existent because now it's taken. So the first, some of the books to close is ordinary, sundry members account, preference, sundry members account, debenture account. We have to do realization account. Those are the major ones. Ordinary sundry members account. We call it a sundry account because it's prepared once. It's prepared what? Once. So ordinary sundry members account, preference sundry members account, debentures account. We have realization account. So after now you have closed those books, you have now to open the journal entries of the new company. So another step, number 3, is to do the channel entries of the new company. Now you are talking about new company, which is now in existence. So after channel entries, after we do the channel entries, then now we finish with step number 4 of doing a statement of financial position of the new company. So those are the 4 steps which you follow when you are doing external reconstruction. Number 1, determine purchase consideration. Close books of accounts. These books are ordinary sundry members account, preference sundry members account, debentures account, and realization account. Step number 3, do the channels of the old company, not old company, new company, the channel entries of the new company. Then final, you do the statement of financial position of the new company. The 4 steps. Under internal, I never mentioned about what's supposed to be done. Internal is very simple, just 2 things which are done. Since we are altering the capital structure internally without the entity losing its legal identity, what we do is just to do journal entries to record the narrations on how the proposals are done. The proposals of reconstructing that entity internally must be narrated in a journal entry. So we do just a journal entry to show that. Then we do 2 T accounts, capital reduction account, the capital reduction account, and ordinary share capital account. Then finally, we do the statement of financial position. That is simple. That is a simple thing, the internal reconstruction. So that is a general introduction for reconstruction. What's remaining is just to do questions. Have you taken something of all the information I have shared? Muko sawa?
Yes.
Hmm?
Yes.
Saida, yes. Now Saida, Dennis, Diana. That marks the end of the session today. I don't want to do a question. We do a question for internal reconstruction tomorrow. We do 2 questions, a sitting question and the question for 2018. It's a question for May 2018, which we have to do. Then we do a sitting question. Those questions are already recorded. They are online. You have them. You can watch before even we do them. So that when we'll be doing them, you do what? You find that the work will be easier. So before we end the session anyway, just to mention a few, internal reconstruction, make sure that you understand the debits and credits, double entry principle. We cannot be able to do without you understanding this. So here we obviously have assets, expenses, and incomes. The accounts of this kind. I always use one word for this. AED. Then we have what we call capital, incomes, so upon this one is drawing. So capital, that is screen. Capital liabilities and incomes. So this one I use one word. We can give it this. So let's look at this. Increase in this account, we do what? With an increase in an asset account, we do what? A decrease, we do what?
Debit.
Decrease. So this one you have said? You did financial accounting, Buan. So debits decrease credit. Credit increase debits. So you must know this. Very important for you to finish your work of reconstruction. Internal, to be more specific. This must be well understood, because journal entries, what do you do in journals? It's all about debits. You pass, when you pass your journals, it's all about debits and credits which are done. That's all. Tuonane kesho kama hakuna swali. Tufanye maswali mbili. Then Wednesday in the morning, most likely from 6 a.m. to taamka hiyo masaa to 8. Or we do from 7 to 9. We do maybe another question for external. That topic will be done as we move forward. Have a good night. See you tomorrow.
Wait, is it Wednesday? Wait. Is it Wednesday or Thursday?
Wednesday.
The whole-
What day? Wednesday.
Huh, okay.
Omega said I think it's Wednesday.